All right, ladies and gentlemen, and welcome back to another edition of the Emerald Financial Group podcast. My name is Sam, and I'm joined by my colleague Tim.
Hi, everyone.
Guys, it's been a big fortnight in financial markets. There's been a lot going on, and I think perhaps the most important, the most relevant bit of information for all financial markets is that US CPI growth came in slightly lower than expected. And looking at the trend, it looks like CPI growth may have now peaked a couple of months ago. So the market is taking this to mean that US interest rates will soon peak, probably in early next year. And that's a fantastic sign for equities. And so stocks have rallied. They jumped very strongly on the night. They continued a bit higher in the US. Our own market is up. Our XJO index is just over 5% away from its all-time high. And yeah, it looks like inflation is over in the mind of investors, Tim.
Key word you keep saying there, Sam, looks like.
Yep.
Does that mean you're convinced or not convinced?
I think we'll see CPI growth drop off a little bit from here, but I'm not convinced that it'll just trend right back towards the sort of 2% level, at least not at the pace that I think the market is expecting.
Yeah, I totally agree with that as well. And looking at the bond markets, there is a lot of indications out there, as you said, that everyone believes interest rates are going to peak early next year. I think we're getting a slightly different message from the Fed, I believe, though.
Yep, definitely.
And the message I'm receiving from most of the Fed members that have been talking over the last week is, yes, the pace of rates increasing is going to slow, but they are going to have to go higher than what the market's pricing and potentially for a longer period of time.
Yep. Absolutely. And I think several Fed members have come out and said now, don't expect a rate cut in 2023. And, this bond market is anticipating a pretty severe economic contraction at some point in 2023.
Yep.
So you'd assume they would expect a rate cut there as well. So that goes to your point. I think, the market is perhaps a little bit ahead of itself.
I think the other interesting take from the last week really is what the bond yield curve has been doing, right? So we've seen the longer dated maturities come off extremely. Like there's a big move, wasn't it? It was 4.2 on the US 10 years, now down at 3.7?
Yeah,
this morning?
Down around there.
And that's inverted the yield curve even further. All right, and what's that telling us? Well, it's telling us of a potential recession to come. The chance of the recession is increasing. Therefore, next year, expect a US recession.
Yeah, absolutely. So, you listen to Jay Powell, and he was saying, 6 months ago, saying, yes, the 5 and 7 are inverted, but that doesn't mean anything. We look at, very short term and very long term. Well, the very shortest and very longest rates are now inverted. Are you still saying that we're going to have a soft landing? Because that's a pretty leading indicator of a recession.
Okay.
I think the Fed's now in a very difficult position. They're going to have to keep going with the interest rate rises, but by the time that the economy contracts, will it be too late to avoid a soft landing? And I think it probably will be. I think we're going to see some pretty tough economic times. Probably after the first quarter of next year would be my best guess.
Yep.
But until then, I think the market will remain mostly positive. So we do have some key events coming up in December. So the second week of December, you're going to see both the CPI data from the US, and then a day later, you're going to have the Federal Reserve meeting for December.
Yeah.
So 2 big potential volatility events. But up until then, over the next couple of weeks, I think it's a period of relative calm, at least looking at the calendar for financial markets.
Yeah, looking at the calendar and then looking at almost everything else that I like to look at is suggesting perhaps a bit of sideways, right? So and when I say sideways, that means, the market can put on a couple of percent, fall a couple of percent and just whip around in a range. So I'm not saying the current move up's over. I do think the S&P 500's got a little bit more in it, but I think it's going to happen very slowly, and then we'll probably give majority of that back at some point between now and that CPI reading in December and just kind of whip around a bit.
Yeah, absolutely. And I don't disagree at all. I think, markets have been optimistic, but I think that optimism is more than priced in now.
Yep.
Sometimes things go on a bit longer than you expect, so we might grind a bit higher, might see a bit of profit taking come in. But overall, I think the optimism, the sugar hit has happened.
Yeah.
And we'll wait to see what the next meal is, whether it's potatoes or caviar. Yeah.
I've been saying something since we started going into a bear trend earlier in the year. I've been saying that I don't think the recovery is going to be like what we saw after COVID, right? So after COVID, we had this massive V-shaped recovery, and that was because of stimulus, and everyone was stimulating their economies. There was only going to be one result at the end of that, and that was going to be a big boost out of COVID. Economies were going to go strong, which is what we saw. But this time around, it's different because when we do go into a recession, if inflation's still sitting at 6%, 5% or even 4%, the central banks, their hands are tied. They can't stimulate until that inflation comes back down closer to their target. Yeah. So in the next 2 to 3 years, you're not going to get that stimulus. You're not going to get that push to drive the economy quickly like what we did out of COVID. We're going to see the exact opposite. We're going to see central banks sit on their hands and wait for that inflation to come back into target again. So for me, this is going to be more of a W-shaped recovery. Yes, you might go into a bull market, but it'll be much slower in pace than what we saw coming out of COVID.
Yep, absolutely. 100% I agree. The ammunition has been used all up, and now it'd be increasingly dangerous to start using more of it. Mm-hmm. So you mentioned, perhaps we're going to see a sort of potential W shape. Mm-hmm. Is there anything particularly you're sort of avoiding, or anything particularly you're sort of staying towards?
And that's a really good point, guys, because when you're in that sort of market where it is more channeling or slow grind higher, for me, you want to let go of your typical ETFs, right? You don't want to just be jumping on the top 200 ETF or something like that. You got to start picking the sectors that are going to outperform. For me, I think materials is definitely a space I want to be in, especially anything to do with green energy. So your copper, and we've said this a million times before. It's all taken a huge run, so I'm not buying today. I'm buying on a dip. Mm-hmm. But if I see, the likes of anything in the materials sector, like BHP is my favourite because you have a good diversified range of things happening there. I'll be picking up BHP on a dip, that's for sure.
Absolutely. And you're right. We have said it before. I'll reiterate it. Many of these base metals kind of have to go higher across the next decade. Yeah. Not necessarily your iron ore, but things like your copper, your aluminium, your nickel, your zinc, your tin. Copper grades that are being mined around the world have tanked dramatically. The easy copper is being used, and yet we're going to need so much more of it if we do have an energy transition across the next decade, and I believe we will. Mm-hmm. Where's that copper going to come from? It's just not there, really, if you look at it. Yes, some will come from recycling, but the reality is we're going to see, I believe, shortages of some of these base metals, similar to how we've seen in oil across the past year, and that's going to shoot the price ludicrously higher.
Yep.
I think across the next 10 years, we'll see at some point copper more than double its previous all-time high. And I'd be pretty confident about that. So if you are a longer term investor, or even in the short term on a bit of a pullback, copper stocks, material stocks, base metals, BHP, great value still. So
100%, yeah. And for me, look, as a hedge, I like Newcrest, especially what's happening in the crypto space.
Yep.
So something sort of gold related, whatever fancies you. But Newcrest I like. As Mike was saying the other day, it takes its gold price from USD, so it's not going to get affected in the pushback up of the AED that we're seeing at the moment. So Newcrest is probably my pick in that space.
Absolutely. And you're right. Maybe with a bit of issue in the cryptocurrency market, a bit more love coming back into gold for the sort of libertarian types, the anti-fiat currency types. They were maybe in Bitcoin, now coming back into gold. Gold's pushing back up a bit. Do want to give a shout out to Mike, who a few weeks ago, probably a couple of months ago now, said that there was more leverage to come out of the cryptocurrency markets with the centralized CFI, leverage marketplaces and things. And he was spot on about that. Obviously, we've had a few high-profile crashes since then, and that did send Bitcoin and the whole crypto sphere, legging lower. So shout out to Mike for being spot on about that one.
Yep.
If you guys missed that podcast, you can go back and watch it. But it's hard to be too enthused about the crypto space at the moment.
Yeah, definitely. definitely. And I think that was some of the money coming back towards equities as well after the last CPI reading, because that was timed quite well with the Bitcoin crash that we saw. And then, the equity market just flew up after that CPI reading. So there's obviously some cash on the sidelines looking for a place to go.
Yep, absolutely.
But look, for me, I want to stay away from the banks right now, especially the Aussie banks. I think, RBA is going to have to keep lifting rates alongside of the Fed next year. I don't think our real estate market's really felt the pinch yet. Nope. And I think that's to come next year. So I'm staying away from the banks a little bit. Don't get me wrong. I always hold my core positions, but I wouldn't be buying into the banks right now. They're a bit high. But you've got to start I'm starting to look at some of those discretionary stocks. Mm-hmm. And you mentioned one this morning.
Which was
ALL.
ALL, yep. ALL had the trading update. Good growth. The market sold it off immediately, but it's now climbing back up. Mm-hmm. They're at valuations now that 12 months ago would have looked extremely cheap. And I think, they're maintaining their growth moving forwards. They're going to look very, very cheap again soon. Yeah. ALL, big proponent of them. I think there's massive upside potential there. But even some of the sort of, more value-based discretionary stocks, something like HiFi, for example, just from a sort of financial ratio perspective, it's so ludicrously cheap. Mm-hmm. One of the reasons that is they haven't provided too much forward guidance. And so all the analysts are forecasting really bad numbers for sort of FY23, FY24, and massive drop-offs in sales and profitability. But so far those sales are holding up. And if those sales, don't drop off, or even if they only drop off a bit, at some point this will just go nuts because it's ludicrous yield, ludicrous earnings multiples, even on those sort of lowered analyst expectations, which I think are a bit unfair to JB it still looks ludicrously cheap. So
And I think with something like that, if you can weather some volatility throughout next year, which we may see if the US goes into a heavy recession, if you can weather that for a year or so, then you're going to have a good buy down here, right?
Yep, absolutely.
And it could happen sooner. Like, who knows? CPI inflation could come off quicker than what we think. So it's worth having some sort of exposure, I think, to some of these, like you said, value discretionary that are cheap.
Yep.
Microsoft for me in the US fits into that category as well. Mm-hmm. Getting into some of those stocks, I think is quite smart right now.
Yep, absolutely. I think, like you're alluding to, they're at cyclical lows in a sort of market cycle. And there's longer term buying opportunities here, even if there might be a bit of fluctuation over the next 12 months.
So that's kind of where I'm at to answer that. We kind of answered that long-windedly, but did well.
Yeah.
Anything else you're looking at the moment?
In the short term, not entirely. I think there's the market sort of recovered a fair bit in since the CPI reading across the past couple of weeks. The materials were boosted by the Chinese stimulus announcement. Yep. Maybe as well a bit of positive relationship building at the G20.
Yeah, that surprised me.
Yeah, yep. But I think it was necessary for the Chinese. Their economy really is struggling at the moment, and that whole geopolitical antagonism, I think, is not helping them. Yep. And at a certain point, they sort of have to go back to, rebuilding their economy. And their economy, in part, was built on Australian resources and US consumerism. Mm-hmm. So you can't really sort of poo-poo that and also get a really strong economic outcome.
Yeah, agreed.
So,
it's better for everyone if we all just work together.
Yeah, absolutely.
Until Trump gets in 2024.
He did just announce he was running. Be interesting to see what happens there. I think Florida Governor Ron DeSantis might challenge him. Maybe he'll sort of try and blackmail the Republican Party and say he'll run independently if they don't pre-select him. But look, it's going to be an interesting few years in US politics for sure.
That's right. All right, I think that's...
Yeah, I think that's it. Looking at the materials sector on a bit of a pullback.
Yeah.
And then, some of the more value-based discretionary stocks from a sort of longer-term basis looking quite cheap.
Yeah. Good stuff.
Fantastic.
Leave it there.
Yep. All right, guys. Hope you enjoyed. If you've listened this long, make sure you give us a like, perhaps subscribe to our channel. And if you want us to discuss anything in future, or if you have any questions, leave a comment down below. Otherwise, we'll hopefully see you in the next one.
Fantastic. Thanks, everyone. Take care and bye for now.
Bye for now.